There are three ways that price makes its movements. First off, you have your uptrend. And how is the uptrend movement like? You have a series of higher high and higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. This is an ideal uptrend. It must give you a higher high. It must give you a higher low. Now, when drawing your higher low, you will need to make sure that the lower low must not be lower than this low because it needs to keep giving you that uptrend pattern, which is higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. Now, example in the chart is this trade that I'm currently I'm waiting for confirmation on GBP/AUD. This is the trade. This is the chart of this market. But this is a downtrend, which is the second way that the price makes its movement. The first is uptrend. The second is downtrend. Now, just like the uptrend, is just a vice versa. Lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. So just like that, it's giving you that downtrend pattern. Now, your lower low must be your previous lower low must be lower than your current lower low must be lower than your previous lower low. The current lower low you can see is lower than this previous one. This current lower low is lower than this previous one. Same thing with the high. This high is lower than this previous high. This current high is lower than this previous high. This current high is lower than this previous high. This current, so it's giving you a downtrend. And if you draw your trend line down, it's actually pointing towards the downside, which is the second way that the price gives its movement. The third way is what we call the ranging market, which in that particular case, in a ranging market, the price of the market is just consolidating. And you see something like this. It's just be bouncing back from a resistance to a support, back to the resistance, back to the support, back to the resistance, back to the support, back to the resistance. So this is what a ranging market, or some people call it consolidation. You see the market giving you just bouncing off, giving you equal highs, equal lows, or going from support to resistance. It's a ranging market. I don't trade a consolidation or a ranging market because as you can see, the price is indecisive. It's just going from point A to point B. It can break up to the upside, it can break down, it can break down to the downside. So I personally just pay attention to either a market structure move of a downtrend or an uptrend. Now, the first thing is to identify the trend, right? Now, I also thought, how do you, I also made mention of concept that we use to join a trend or reverse a trend, because when you come and you have spotted out your trend, if you like, for example, you spotted out this downtrend, for example, the first thing you want to do is, am I taking a reversal, which means am I opposing the trend, or I am continuing in the downtrend? That is the first thing you want to ask yourself. When you spot your trend, you spot your trend. Me, I spot my trend for a higher time frame. I don't just jump into I don't use a lower time frame to get my bias on my trend. I get it from the higher time frame. So the first thing, like I said, is when you spot your trend, you want to ask yourself, am I joining the trend or am I taking a reversal, which means am I opposing the trend? So what that means is that this particular trend was on a downtrend. Now, am I continuing in this downtrend or am I opposing or taking a reversal of this trend, which means I'm start going to looking out for buys? That's what I'm going to ask myself. Now, you don't just jump into anyone. You take the one that the market presents to you. If the market gives you an opportunity to reverse the trend, that is what you should trade. If the market gives you an opportunity to join the trend, that is what you should look out to do. So take note, you're in a trend market, either an uptrend or a downtrend. It is either you're looking to join that trend or you are looking to oppose the trend, which means you're taking a reversal. You can write these things down or you can watch this recording and write it down. Now, like I said, you take the one that the market gives to you, right? In this case, the market gave us what we call a market structure shift, which is the concept that we use to oppose a trend or to take a reversal. When I say oppose a trend, it's the same thing as reversal. In this case, the market gave us a market structure shift, which, like I said, is a concept of taking a reversal. Now, in a just a line graph, this is how it looks like. Normally, this is how your downtrend is. Lower low, lower high, lower low, lower high, lower low, lower high, lower low. Now, this is a downtrend. A downtrend would have given you another lower low and another lower high and another lower low. This is what a downtrend give you, right? But the moment that it takes out, the moment that your last lower low take out your last lower high, you call that a market structure shift. I'm coming. You call that a market structure shift. Give me 1 minute.
All right, there, please. Can you come again?
All right, can you hear me? Can you still hear me? Please, hurry up. Can you still hear me? Can you hear me? Can you hear me?
Can you come again? Yes.
All right, cool. Now, um, like I said, this is a concept of market structure shift, or this is the way it gives you the moment for this downtrend, this last lower low took out this last lower high here. This is the last lower high. This is the last lower low. It took it out. Now, you need to make sure that it takes it out with a body, a candle body. That is when it confirms a market structure shift. Now, this is a sign that this downtrend here has come to an end, and an uptrend is about to now begin because of this market structure shift here. Now, why is it a market structure shift? Because in continuous downtrend would have not given you would have not taken out this lower high, because that's not the pattern of a downtrend. A downtrend would have given you another lower low and then another lower high, and then it would have given you another lower low. That is what a downtrend would have given you. That is why we call this a market structure shift, because the last lower low for this downtrend took out the last lower high. So that is now when we now confirm a market structure shift, just like in this case right here. You can see this was the last lower low, last lower high, last lower low, last lower high, last lower low. Now this last lower low came and took out this last lower high, causing a market structure shift. You can see on the previous downtrend formation, the lower low was the recent lower low was always lower than the recent lower high, right? This last one was lower than this last one. But in this case, this last lower high took out this last lower low. Now you need to make sure that it is the last lower low that takes out your last lower high for a market structure shift. What do I mean by that? Sometimes you might see the market giving you something like this. It can just do like this, and then it will now do something like this. Now, if something like, or let me even not put it there. If something like this happens, you can see something like this, right? Sometimes the market will show you something like this. This is your last low, and this is a high. Now, some people will mark this as a market structure shift here, but I will not call this a market structure shift here. Why? Because for a market structure shift or for a clear market structure shift, it is the last low that needs to take out the last high. But in this case, you can see this low here is not the last low. This is the last low. The low needs to be, except the low was lower than this low. That is when, and then it took out this last high. That is when I'll call it the market structure shift. But because this low here, this last low was not lower than this low, I will not call it a market structure shift. But then again, if this candle now goes ahead to now take out this last high here, I will call this point in my market structure shift because this is the last low and this is the last high. So like I said, the last low needs to take out the last high. Like in a downtrend, that is when you call it a market structure shift, right? So now when your market structure shift now happens, like there are other criteria that you need to look out for, right? You don't just rush and start buying. No, there are other things that, like your liquidity, like your getting the right POI, and also confirmation, which we teach in higher classes. So now this is the concept for joining a um reversal trend. There's also another one on so okay, like gold, for example. Let me use gold now. Gold, for example. Gold, okay, I think it was the other chart. Gold was on a downtrend, right? Or gold is on a downtrend, and it has given us gold was on an uptrend and has given us a market structure shift to the downside, right? I hope you can still hear me. So see gold, right? Gold is on an uptrend here. Higher high, higher low, 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 higher high. Now you can see what happened here. This last high, this is the last high. This high is higher than this high. That is why this is the last high. This last high took out this last low with a body. You can see the body, and the body closed below that last low. Now, that gave us what we call a market structure shift. And, this is our liquidity. And then this is the point of interest that I am looking out for to sell. But I'm not just going to rush and sell. I'm going to look out for other criteria and other confirmations to play before I now take this trade. Like I said, we'll discuss in future classes. But I want you to know that this is the concept that you use to join in on a reversal, or if you want to oppose or reverse a trend. If you see the market going on an uptrend, before you start looking out for to reverse this trend and start selling, look out for this concept first. If you see the market on an uptrend, before you start looking out to oppose the trend and start selling, look out for a market structure shift first. Now, the next, like I said, if you see a trend, an uptrend or a downtrend, it's either you're looking to join the trend or to reverse the trend. We have talked about reversing the trend. Let's talk about joining the trend. Now, for joining a trend, we look out for what we call multiple break of structure to join a trend. Now, how does that mean? Let's say, you know, let's say the market was on an uptrend and then it gave you your market structure shift, which is a reversal, and then let's say it now came and tapped your POI, and then it's now starting to go in a downtrend. Remember, it was on an uptrend before, but the market structure shift has occurred, which is this right here, and now it is now making a downtrend move. Now, this is now the downtrend move. Now, if you missed maybe the market structure shift entry, you can also join in the continuation entry because now the market is on a downtrend, and you know that there's a liquidity to clear here. Our next class is supposed to be liquidity, right? But because you know that the market is eventually coming here, but it's still far, you look out for the opportunity to join the trend to complete this liquidity by joining what we call a multiple break of structure. A multiple break of structure is when the market takes out more than one consecutive zone. right? Or more than one key zone. Let me put it that way. For example, here, right here, when the market was making this move, it took out this low right here. This is what we call a single break of structure. I will not enter the trade, or I'll not look to enter the trade yet, because it has only taken out one key zone. But when the market now goes ahead and take out this other key zone here, this is now what we call a multiple break of structure, because it has taken out more than one. It has taken out this key zone and only this, and this key zone as well. So I can now look to join this trend right here, this downtrend. I can now look to enter from here. If my POI gave me this entry or this entry, I can now look to enter from here and then, continue. Now, even as the market is making another move, you can see as the market took out this zone right here, this key zone, it also took out this what? Key zone. So this is another multiple break of structure. So it is a multiple break of structure concept. Take note, is for you to join a continuation trend, you need to look out for a multiple break of structure concept. Now, let me give an example. Although I've not traded gold for for weeks now, but this Euro USD trade, right? Now, this Euro USD trade, although I took this particular trade from from market structure shift, because on the 4-hour time frame, the market was on a downtrend, and this my confirmation was here, but I took the trade, right? But what I want to show you is the multiple break of structure, which I'm currently waiting for this entry. And why am I looking out to enter from here? When the market started moving from this market structure shift here, right, and started buying to take out this liquidity here, you can see there's a break of structure here. There's a break of structure here. The market took out a high here, right, which is a single break of structure, and it took out another high here, which is now multiple break of structure, because it is now more than one. And it gave us our liquidity, which is another criteria, and I'm looking out to enter from here. But why am I entering from here? Because of this multiple break of structure here. On GBP USD as well, I think some trades that entered back on GBP USD was from if I've not cleared it, sharp. So, but there's actually no current multiple break of structure aside that Euro USD, because these days, market has been changing structure, so we'll just be looking out for market structure shift. But then again, it's important that you understand it, right? Where is that chart, sir? Yeah. So, like now, if this market finally gives us a confirmation and we enter from here and then we start selling, right? And we start selling and the market start moving like this, right? Let's say if you caught this entry, fine. If you did not catch, now as the market was making that move and it took out this zone, you have a single break of structure. When it takes out this zone, you have another single break of structure, because it is just one key level that it is taking out at once. But once the market takes out more than one key level at once, you now have what? A multiple break of structure. So this has now confirmed my concepts for now joining in this sell that we want to take and reverse the market, right? Then I can now, from other criterias, I can now be able to now pick my point of interest and then join the trade and keep moving in that direction, right? So like I said, for multiple break of structure concept is for joining continuation. Market structure shift is for joining reversals. Now, for multiple break of structure, um, if you want to join it, although you can, most times, if the market has already given you a market structure shift on a higher time frame, you don't need to still use that higher time frame to check for your multiple break of structure to join the trend. You just use lower time frames to just continue the trend, so long as there's still liquidity to clear and it has given you your market structure shift from the beginning. All you just need to do is just keep going to lower time frame, keep looking out for multiple break of structure until that liquidity area has been cleared. So I just need to rush this. I've done this in the previous two classes, but you guys still did not catch up. So I'm doing it again. So now we can now move on to liquidity. That's if we still have time. Now, what is liquidity? Liquidity literally just means money. That's what liquidity means. When you hear the word liquidity, it means money. And in the market, there's always liquidity, which means there's always money in the markets. Now, there are types of liquidity. Now, before what you need to know, for you to enter a trade, liquidity is very important. We use it to enter a trade, we use it to exit the market. We use liquidity to enter the market, we use liquidity to exit the market. But there are different types of liquidity. Now, the liquidity that we use to enter the market is what we call the inducement liquidity. Now, an inducement liquidity mean? An inducement liquidity is the first valid pullback. It is a pullback. It is the first valid pullback after a market structure shift or a double break of structure.
Sorry, please repeat what you just said.
I
Repeat
said
what you just said.
I said a liquidity is the first valid pullback before a market structure shift or sorry, after a market structure shift. I was trying to reply this guy that asked for link. A liquidity or an inducement liquidity is the first valid pullback after a market structure shift or a multiple break of structure.
After a market structure shift or a multiple break of structure.
Yes, that is your
Okay.
liquidity. That is your inducement liquidity.
Okay. All right.
Now,
Okay.
let me explain that. Now, when once market gives you your market structure shift, there's always going to be a pullback. For example, as this market structure shift occurred here, right? You can see your liquidity can be a tiny wick, right? Or a body, so long as it's a pullback. Now, in this case, you can see this is the candle that caused the market structure shift, right? This is where the candle closed, and there was a small pullback. You can see this week. This is your liquidity here. After your market structure shift or a break of structure or multiple break of structure. Now, let's go back to that Euro USD trade that I marked. Now, can you see this point that I marked? When this break of structure occurred, this was the candle that caused the multiple break of structure. It took out this candle, it took out this high rather, and this high at once and gave us a multiple break of structure. You can see the candle closed above the wick, right? And then this pullback here, this pullback after the candle that caused it closed, that's where I marked my liquidity. Now, for your liquidity to be valid, for your inducement liquidity to be valid, it needs to take out the candle that caused that market structure shift or double break of structure, right? For instance, if maybe let's say your market structure shift occurred like this, and then maybe the pullback, this is your pullback, right? And then your pullback for this your pullback to be valid, for this your inducement liquidity to be valid, it needs to take out this candle that caused this is your market structure shift, right? Here. And this is your liquidity here. For your liquidity to be valid, it needs to take out this candle that caused your market structure shift here. The body, your liquidity needs to close above the body. But if let's say it didn't close, maybe it came down here, it was struggling to close with a body, it did not close, it made another pullback and then tried again, it did not close, it's not valid here. It needs to close with the body. If this candle now eventually takes out this candle that caused it, this is now where you will now mark as your liquidity. I hope that's clear. So that is why the reason I marked this here is because you can see this candle, it went higher and even closed above it. You get this same trade that I also analyzed on GPAUD. Same thing. I also waited for the liquidity. right, which is the pullback GBP AUD. I waited for the pullback, right? Trade was on a daily time frame. Right? I waited for the pullback, and which was the liquidity. And you can see the liquidity here. It took out, see the candle that caused the market structure shift. See the candle here. This is my liquidity. My liquidity took out the candle, right? It took out the candle body and also the wick. So this is a valid liquidity here. So that is the concept of liquidity. I'm only going to talk about inducement liquidity in this class because the time is almost up, except I will start a new class after 10 minutes. So, but I think I should start a new class after 10 minutes rather. So, because this class is about to end, so I will save this one and then I'll I'll start a new one after 10 minutes. But then again, this is your liquidity. If you have questions, you ask in the next Zoom. Let me give that explanation again. Let's say you have okay, let me use this example. Let's say you have your market structure sheet and then maybe it has triggered now. Remember, for your continuation, we use a multiple break of structure to join the trend. So because this is a multiple break of structure that has occurred, I can now look out for more buys to clear this trend line liquidity here. I'll also talk about this liquidity that we use for taking profit. So now we have a trend line liquidity to clear here. So we can still keep looking for buys. And for us to do that, we need to look out for multiple break of structure. You can see this is a break of structure here. This is another break of structure. Oh, this is actually a market structure shift rather. And then this is the candle that caused the market structure shift. And then it made its pullback, which is the liquidity. And the liquidity now took out this candle that caused this market structure shift. So this liquidity or this point or this week is now what we call our liquidity. Now, our entry always has to come after our liquidity, not before our inducement liquidity. So for us to now enter this trade, we now need to now enter from below. I'll still teach about point of interest, and then you can now start buying, right? Now, let's say your trade has now triggered your entry, and then it's moving, it's moving, it's moving, it's moving, it's moving. Now, take note, there's no multiple break of structure yet, though. It's moving, it's moving. Now, something like this now happens, right? Remember, there's no multiple break of structure because all these ones are just single break of structure. That's a single break of structure because it just took out one high at once. It just took out only this high, so it's still single. This one too is still a single break of structure. This one too is still a single break of structure. So we cannot now start looking out for continuation. But now you can see this candle now took out this high, which is now a multiple break of structure because that's not just taking out this high, that's taking out all these other single highs. So this is now what we now have as our multiple break of structure. So because of this thing that has happened here, we can now look out for an entry to keep buying. But before then, we need to see our what inducement liquidity, which is the pullback that will occur after that candle that took out that caused that multiple break of structure. After that candle closes, the pullback needs to now take out the high, like I said, take out the candle that caused the multiple break of structure or market structure shift, whichever one. In this case, is multiple break of structure. So your pullback has to take it out. If your pullback struggled and it could not, even though it closed above with a wick, it's not a valid inducement yet. Your pullback needs to close above with a body. If it struggled, it did not meet up. If it struggled, it did not meet up. If it struggled and it closed above with a wick, it's not still valid as an inducement. But the moment a body closes above that candle that caused your multiple break of structure or your market structure shift, you now have what? Your liquidity. So in this case, this is now your liquidity. And like I said, your entry always will come after your liquidity. So because your inducement liquidity has occurred, there are rules that I look out for. I'll explain the rules when we enter point of interest class, but always know that your liquidity has to occur before you enter a trade, your inducement liquidity. So I can now enter this trade and, keep moving. So that is the concept of inducement type of liquidity. I hope you understand. And please go back and watch this video. Thank God I recorded it. Go back and watch this video on this type of liquidity. What is it called? Inducement liquidity. If I ask you guys question, what is the liquidity that we use for entering the market? You should know that it is the inducement liquidity. And what is the inducement liquidity? It is the first valid pullback after a market structure shift or a double break or a multiple break of structure. It needs to happen after your MSS or your multiple break of structure, right? So this class is about to end, so I'll drop this one, right? Then in 10 minutes, I'll reopen the Zoom so we can talk about the other liquidity that we use to exit the market. Remember, you need liquidity to enter the market and exit the market. This is the liquidity for entering the market. We will talk about the one for exiting the market in the next class. So see you guys on the next class.